You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Today I want to talk to you about basically what to buy when you feel like the market is overpriced. So for myself, right now, investing in the current share market when you feel like all the prices are at all-time highs and you are sure a crash is coming, but you don't know when, and it's pretty much impossible to time it. Your mind is pretty much trying to overthink and feed you all of these stories. Just hold cash, don't buy in, etc. But with so much stimulus being printed and put into the economy, and so many people making these bets on certain industries or companies going up, it's also very scary to miss out on that opportunity when you feel like you want to put your funds to work in the market. So there are basically a few plays you can make that, keeping up that consistent behavior will allow you to still capture the returns of basically the whole broad market. You're not going to have that fear of missing out, but you're not going to basically send yourself broke if there is a crash, okay? So there are certain sectors within the stock market that tend to perform quite well, even when the rest of the economy isn't doing so well. And this sort of balances out the volatility of the market if you hold everything. So you could buy a broad market index ETF at no matter what price the general share market is. And this is actually going to be quite beneficial because even if there is an entire market dip, you're going to have, no matter what stock you hold, pretty much go down anyway. So holding an ETF that tracks an entire broad market is going to sort of balance out that volatility. If we have a resource crash and, all of the gold, silver, copper, all of those resources goes down in value, but in the meantime, financials and real estate have gone up, holding a broad market index ETF will allow that to sort of balance out that volatility. Now, you're buying with one trade a diverse basket of lots of companies and lots of sectors and lots of properties based on the assets that these businesses hold. So this is basically going to allow you to, no matter what level or how expensive the market is, to be assured that you're going to keep putting your money to work and you're going to earn a return. Now, there are certain markets out in the world or certain ways to purchase shares that allow a better dividend yield than growth. And if you feel like the share price is extremely overinflated, and looking at all of the sort of metrics and how to measure that, like the Schiller PE, etc., you may feel like there is a crash coming. So making a play with a higher dividend yield ETF or a REIT or something like this is going to possibly be a better play, as it should experience a lesser price fluctuation than a growth ETF. So for myself, I see the most volatility through holding United States tracking market ETF, which holds the top 3,600 companies. And this particular ETF actually fluctuates a lot in price. It's gone up $90 since the start of the pandemic last year, and it's increased another 50% since then. So the price fluctuations are enormous and the dividend yield is really low. So when I'm looking at an overpriced market, it would not be wise for me to put that money into the market when I feel like it's overvalued. But then I could make maybe a different play with an ETF that tracks perhaps the Australian market, which has a higher dividend yield. When there's a crash, there's generally less fluctuations in higher dividend paying stocks than there is in capital growth stocks, because the dividends balance out some of that volatility. Obviously, I want to keep dollar cost averaging my money into the market every single month, but when I feel like it's overpriced and there's less opportunities for me to do so, I'll stick to my minimum investment objective, which I want to place in the market every single month at least $1,000. If I feel like there is any better opportunities out there and I can put more money in, then by all means I should. So for example, if I see a dip of say 5 to 10% within the month, when I'm putting that money in, if I have an extra $300-400 that I can attribute to this, it would be very wise for me to add that investment to that $1,000 and make that extra amount, because I feel like I'm getting better value for my dollar. The worst thing you can do, however, is overthink to the point where you're not willing to put that money into the market. So you keep hesitating, and you sit on your money for the whole time earning no return, while your money could have been earning you returns of the market. Yes, that price will fluctuate, but it's sort of proven that time in the market actually is more effective than timing the market, which means by putting your funds in early as soon as you have available funds, you're going to, over the long term, earn a better return than if you sit on your cash and wait for that opportunity. In saying that, there's nothing wrong with holding a bit of cash aside, ready to deploy as soon as you feel like an optimal, opportune moment comes up, but definitely don't miss out on the long-term returns and keep increasing your contributions every month in order to capture the rising stock price over the long term. For myself, when I have extra funds available, I try and deploy them straight away, but I still keep a little bit of cash on the side as an emergency fund, which covers any sort of property maintenance, any emergencies that I have. If I find an opportunity, I can simply grab some of those funds, chuck them into the stock market, and hopefully get a great return because I feel like there was a good opportunity to do so. So I want you guys to think about basically your dollar cost averaging strategy as understanding that the market is practically impossible to time, and we never know where the stock price is going to be tomorrow or the next day or even next month. But what we can assume is that over the long term, every 5 to 10 years, we're going to see an upward trend as that the economies grow and businesses thrive and new technologies and new industries are created. We're going to see that cash flow increase as human endeavor creates these opportunities. Inflation is basically occurring at a rate of 2 to 3% every single year on average, and we want to be in a position where our money can work and outpace the rate of inflation, because otherwise holding cash, we'll lose the buying power that cash had. If we have that money in assets such as property, shares, and earning interest in loans, we're going to be able to assume that that the returns from doing so, that having these cash flow assets, we're going to assume that the returns are going to outpace inflation. Therefore, we're going to be better than having had left our cash on the side. So try and deploy your funds as frequently and as often as you can and as much as you can, whilst also keeping enough cash on the side that you can sleep at night. Because the worst thing you can do is invest in a way that causes you sort of angst and anxiety. We want to be comfortable and we want to have a strategy that works for us so that we stick to it and we have high conviction. If for any reason I were not to follow my strategy, then I would stop what I'm doing. I would start sitting on my cash or spending it, recklessly. And, that really inhibits the amount of money I can return to myself throughout my investment journey. So when I'm talking about these higher dividend paying stocks or ETFs or REITs, in Australia, we have listed investment companies that with franking credits can pay up to, 6% dividends per annum. So I'll be better off putting my funds into this than an overpriced ETF where perhaps there's a lot of growth stocks in there and I'm going to have less returns if I feel that things are overpriced. At least I know I'm making a good dividend play here. I could also purchase a REIT. Real estate investment trusts are quite good with tax efficiency when it comes to dividends. A lot of that tax component is covered through depreciation, interest, and any claimable items that are occurring within that rental income. You can also receive really high dividend yield from REITs, with the one I personally hold, CLW or Charter Hall Long WALE REIT, returning 6.1% dividends per annum, which is fantastic. When I feel like the market is undervalued, I might make less of a dividend play and put my money into those more growth style ones like the VTS or United States Whole Market Index, or VEU, the entire world minus United States market index. The dividend yield of these two are really low, but the growth of the stock price or the share price is amazing. And you're looking at, sort of 10% growth per annum, which is insane. It's insane. So at the moment, I feel like the stock price is very high. Obviously, I have no idea what's going to happen. So every sort of third or fourth month, I make one of those purchases into the growth ETFs, so either VEU or VTS. And the rest of the time, I have been buying VAS, I've also been contributing a little bit of money into my REIT, CLW, and then listed investment companies like AFI and AUI, because these are the two listed investment companies that I personally want to hold for the long term and receive a fully franked dividend. So guys, I hope that gives you a little bit of insight as to where you can sort of deploy your funds when you feel like the market is possibly overpriced. I hope it gives you a bit of guidance. You know, we want to still be investing that money, and we don't want to sit on our hands and overthink, okay? I want you guys to really think about getting that money in the market so that you can start growing your net worth. By hesitating and overthinking for too long, you could miss out on an amazing growth run, you know? And had we sat on cash for all of last year, we would have missed out on a 30% recovery in the share market. So I encourage you guys to dollar cost average as much as you are comfortable, as often as possible. Sit on some cash ready for those opportune moments, but don't stop investing altogether. That is the worst thing you can do. And I want you guys to stay in the market. So guys, if you got any value from this video, please like, share, and subscribe. And I look forward to seeing you in the next video.